Hi, everybody. I'm the chairman of Strategic Analysis Corporation. Welcome back to Friday Focus, our SVA in Action series. Today, I'm going to try to answer the question, who cares about the balance sheet? And more to the point, why you should. The bitter truth is that most investors don't pay any attention to the balance sheet until something untoward happens, which it usually inevitably does. And then, when I'm on BNN, Bloomberg TV, they phone up and whine, "What happened, Ross?" And I have to tell you, it's very often a balance sheet issue. But I don't know how to read a balance sheet. And frankly, it sounds like work. Well, three things. First, you're in good company. Few investors do. But secondly, it's imperative that you learn. And third, that's why people use our SVA service. We make using the balance sheet very easy. And why do we focus on the balance sheet? When I have a new client come to us, I always tell him that there are three things that you need to know about a company before you should even consider investing. And the first one is, what is the quality of the balance sheet? Now, on your screen, you will see a graphic which is headed up the solvency curve. And you will see on it here the trade-off between balance sheet quality on the x-axis and price potential on the y-axis. Now, we understand, of course, that if the company is very weak, then obviously the price potential is going to be fairly poor. And as the balance sheet gets better and better, so the price potential goes up and up and up. But a funny thing happens. It peaks out and starts to head down again. And why does that happen? Well, a very strong balance sheet usually means that a company has got a lot of cash and investments on its balance sheet. And quite frankly, the stock market pays management to work those assets, not to sit on them. If you're going to sit on them, pay them back out to us, but don't keep them yourself. Otherwise, we will mark you down in the market. That's the strong side. Now, turning to the weak side, here we have what we call our three stages of insolvency: first, second, and third, and I've given you the numbers that are attached to them. By the way, if you want to know how that solvency ratio is calculated, just go to chapter 2 of my book, Inside the Market, when it comes out, and it's all there. It's nothing secret. Okay, so we've got three stages of insolvency. Moving down, we're going to get to the second stage of insolvency, which we consider to be a first order bankruptcy. And then we go down to a third order. In between there is a kind of a no man's land. Just because a company falls into that condition doesn't necessarily mean that they're going to go bankrupt today, next week, or even next month. But it is a warning, however, that the balance sheet does not sustain the company as well as it should, and therefore it's highly risky. Now, enough verbiage. Let's go and take a look at a company. And the company that I'm choosing to look at is Beyond Meat. That is an intriguing company here because we will see that the stock price has fallen a very, very long way. How far? Well, if we go to the peak, we'll see that the stock reached $248, and today it's at $3. In other words, the stock has fallen some 99% in that period. Now, it's not only the stock price that's fallen, we see that the balance sheet has fallen as well. You will remember that those lines are multiples of book value so that we can actually see what's happened to the balance sheet. And if we look closely, what we will see is that the book value per share has fallen by some 92%. So what we've got is a price that's fallen faster than the book value. So is there possibility of a little catch-up? Well, apparently some investors seem to think so, because they used that opportunity when the stock got to its LSG price, which is 4.5 times book value, to step in and do some buying. The question is, should you? Well, to answer that question, we are going to look at the quality of the balance sheet. And to do that, we are going to look at something which I have here called the stability ratio. But wait a minute, Ross, you said before that the balance sheet quality was measured by the solvency ratio. What's with the stability ratio? What I have to tell you is that when I'm on BNN, Bloomberg television, I can't say that a company has weak solvency. If I do that, the first phone call I'm going to get when I get back to the office is probably going to be from the company's lawyers. They do not wish to be accused of being weakly solvent or insolvent. However, if I say that a company has weak stability, what's that? Okay, by the way, of course, if you've got a weak balance sheet, you know it. And you're not about to argue that. You just don't wish to be accused of being insolvent. Therefore, we are going to look at that stability ratio and say, look, we know where that fell, eh? It fell below a second and a third order insolvency. So this balance sheet is very, very risky. I would let somebody else have this stock. I don't think that you would want to have this yourself. That's for certain. Anyway, the stability ratio has been falling for years, and so has the balance sheet. So this is not a company that I would call investment quality. Anyway, bottom line is always look at the stability ratio, the solvency ratio first. It tells you in one glance how strong a balance sheet is, whether the company can pay a dividend or even increase one if it has one. If the company is attractive as a takeover candidate, does it have the internal resources for strong growth? All of that in one number. That's why I call it your first line of defense and support. Now, if you like what you see here, go to strategicanalysis.ca. Our website, our service, follows some 3,000 companies, and therefore we are almost guaranteed to at least keep you out of solvency difficulty, if nothing else. Anyway, that's it for this week. Have a good week. Donald Trump's machinations beside, and I'll see you next Friday.